If I had to look at Bitcoin today from scratch, knowing what I know about this chart, the ETF money coming in, the stock market ripping into record territory, and the way crypto loves to trick people right at the worst possible moment, I would not treat this like a clean breakout yet. Most people see Bitcoin near the upper range and immediately think the danger is gone. They see green candles, they see altcoins waking up, they see everybody getting excited again, and they think, okay, the train is leaving without me. But that is not what this setup is really about. This is about the difference between a bounce you can trade and a trend you can trust. Those are not the same thing. And if you confuse them, the market can take a very expensive tuition payment from you. Today is Sunday, April 26, New York time, so comment the day and date you are watching from, because this Bitcoin setup can look very different depending on when you see it. And if you value this kind of straight market breakdown, subscribe and comment John AG Best, because it tells me you want more of this calm, simple, no-nonsense analysis. So let us walk through this properly. Bitcoin has already done the first thing bulls needed. It gave a strong green reversal from the lower area, then held that zone, then started climbing in steps. Push, pause, push, pause, push again. That is healthy short-term behavior. It tells you buyers were not dead. It tells you shorts got too comfortable. It tells you there was enough demand to squeeze price back toward resistance. But here is the part people skip. A short-term reversal candle does not automatically erase a larger bearish structure. It can start a rally inside a bigger downtrend. It can create a strong trade without creating a new macro uptrend, and that is exactly why this moment matters. Bitcoin is now sitting near the place where the old easy trade becomes a harder decision. Earlier, when price was much lower, the upside window was wider. The risk-reward looked cleaner. You had room between the entry zone and the overhead ceiling. Now we are closer to that ceiling, and when you get close to resistance, you stop asking, how much can I make? You start asking, how much am I risking to chase the last part? That is the whole game right now. Based on recent market updates, Bitcoin is still hovering around the high 70,000 area, while Ethereum is sitting in the low 2,000 area. Solana is in the high double digits, and XRP is around the mid $1 range. That means the market has recovered enough to get attention, but not enough to prove that every major resistance level has been conquered. And there is a big difference between reaching resistance and defeating resistance. A market can touch a level, it can poke through a level, it can even wick above a level and make everyone on social media act like the case is closed. But a wick is not a victory. A wick can simply be the market reaching up, grabbing liquidity, trapping late buyers, and then turning around. That is why I care about acceptance. If Bitcoin pushes into the next major upper zone and holds there, builds there, and refuses to give it back, then fine, the chart changes. We respect price. We do not fight it just because we had an opinion. But if Bitcoin only jumps above resistance for a moment and then loses it, that is not strength. That is a warning flare. And I know nobody likes the warning flare when candles are green. It ruins the party. But the party is usually where bad trades are born. The larger Bitcoin structure still has a problem. We had a hard move down, then a grinding recovery that looks more controlled than explosive. That type of action can become a bear flag if buyers fail at the upper band. It does not have to break tomorrow. It does not have to break at all. But until the upper resistance is truly reclaimed, you have to respect the possibility that this whole move is still a relief rally inside a bigger corrective pattern. So short term, yes, Bitcoin can still squeeze higher. But macro, the chart has not fully earned trust. That is uncomfortable, but it is honest. Now, fresh context makes this more complicated. Since spot Bitcoin products were approved in the United States, a new type of buyer has entered the market. Retirement accounts, institutions, advisors, and treasury-style buyers now have easier access than they had before. That matters because ETF demand can support dips and create persistent bid pressure. From recent market updates, those funds have seen a renewed inflow streak, with roughly a couple of $1 billion coming in over a little more than a week. That is not nothing. That is real demand. It helps explain why Bitcoin has not just collapsed under resistance. But do not turn that into a fairy tale. ETF demand can support a market, but it does not remove downside risk. If everybody piles in at the same resistance zone, the market can still flush. Big money can be wrong short term. Institutional flows can arrive late. And when positioning becomes crowded, a failed breakout can unwind faster than people expect. That is the counterpoint. The bullish side has inflows, improving sentiment, and reduced panic. The bearish side has overhead resistance, a possible larger bear flag, and a stock market that may be stretched. And yes, we have to talk about stocks. The Nasdaq and broader market have been pushing into record territory again, helped by a powerful technology rally. That sounds good for risk appetite, but vertical strength also creates exhaustion risk. When tech stocks rip too far too fast, they do not need a crash to pressure crypto. Sometimes even a normal pullback is enough to make Bitcoin wobble. This matters because Bitcoin has not been trading like some perfectly independent rebel asset. In many recent periods, it has behaved more like a high beta risk asset. When liquidity feels good, it runs. When technology stocks feel strong, it benefits. But when the Nasdaq rolls over, Bitcoin often feels that pressure too. So here's the question. If the Nasdaq pulls back just a little from a stretched position, does Bitcoin break higher with confidence, or does it stall right under resistance? That answer matters more than any loud prediction. Because if Bitcoin cannot rise when stocks cool off, then the breakout case is weaker than people think. And if Bitcoin can rise even while stocks pull back, then that would be real relative strength. That would deserve respect. Ethereum is the next clue. Ethereum still looks like it may have one more push left. It has not shown perfect leadership, but it has enough room on the chart to test a higher resistance zone. If Ethereum starts moving with force, it can give altcoins oxygen and help Bitcoin make that final attempt into the upper band. But Ethereum has its own problem. A final push into resistance is not the same as a clean new trend. It still has to hold higher levels. It still has to prove buyers are willing to defend the move after excitement fades. So with Ethereum, I would be open-minded but not careless. Solana is similar, only faster. Solana can move like somebody cut the brakes, and that is why traders love it. But speed cuts both ways. If it keeps holding its rising support, fine, the move can continue. If it breaks that support, you do not stand there giving a motivational speech to a red candle. You accept that the short-term structure changed. XRP is another important piece. XRP has been floating higher, and the price is pressing toward an area where sellers have shown up before. The first overhead zone matters because several previous turning points cluster around it. If XRP clears that area cleanly, it can move toward the next shelf fairly quickly. But that next shelf is not friendly. It used to act like support, and when old support breaks, it often becomes resistance later. That is one of the simplest market rules, and it keeps working because traders remember pain. So if you are holding XRP for a short-term move, you need to know whether you are trading resistance or investing through it. Those are different games. A long-term believer can sit through more noise. A swing trader should not pretend to be a long-term believer just because the exit got uncomfortable. And this applies to every coin we are discussing. Know your time frame before the candle forces you to admit it. If you're successful, share your success story in the comments so others can stay motivated. Now let me give you the clean scenario map. Scenario 1, Bitcoin pushes above the upper resistance zone and holds it. Not for 5 minutes, not with a little wick. It holds, builds, and turns that old ceiling into a new floor. If that happens, the bearish case weakens fast. Altcoins likely get another wave, Ethereum gets a cleaner path, and the market starts looking much more constructive. Scenario 2, Bitcoin spikes above resistance and fails. This is the fakeout scenario. It is the one I am most careful about because it creates maximum emotional damage. Bulls buy the breakout, shorts get squeezed, everyone celebrates. Then the candle reverses, the level is lost, and suddenly all those new buyers become potential sellers. That is how fakeouts turn into fast drops. Scenario 3, Bitcoin never really breaks the upper zone. It stalls, chops, loses momentum, and then breaks the lower rising trend. If that happens, the market starts looking for the next major liquidity area below, and the 50,000 region comes back into the conversation. Not guaranteed, on the table. There is a big difference. And please understand, talking about downside does not mean hating Bitcoin. It means respecting risk. I like markets that make sense. I like plans. I like knowing where my idea is wrong. Blind optimism is not a strategy. It is just hope with better lighting. The same goes for altcoins. They can absolutely keep moving if Bitcoin holds together. In fact, altcoins often look best right before Bitcoin reaches its decision point, because traders rotate into higher beta names while the big coin pauses. But that can also be late cycle behavior inside a short-term bounce. So again, respect the move, but do not marry it. Based on recently published numbers, the broader crypto market is not dead. Bitcoin dominance is still meaningful, ETF flows have improved, and sentiment has recovered from the panic phase. But recovery is not confirmation. Confirmation comes from levels holding after the crowd gets excited. That is the line I want burned into your head. Do not judge the move only by the breakout candle. Judge it by what happens after the breakout candle. If buyers defend the level, that is information. If sellers smash it back down, that is also information. The second reaction usually tells you more than the first move. So my view is simple. Bitcoin can still push higher into the upper resistance area. Ethereum may still have room. Solana can continue if support holds. XRP can test higher resistance if buyers keep control. But Bitcoin is no longer sitting in the sweet spot of the earlier trade. The upside is tighter now, while the downside, if the bigger pattern breaks, is much wider. That does not mean panic. It means discipline. If you are already in from lower levels, this is where you manage. If you are late and trying to chase, this is where you slow down. If you are waiting for confirmation, this is where you let other people fight over the first candle, and you watch the close, the retest, and the follow-through. The market will always tempt you to act before your plan is ready. That is its job. Your job is to not be the liquidity. Watch Bitcoin near the upper zone. Watch whether it holds or only wicks. Watch the Nasdaq, because crypto is still sensitive to risk appetite. Watch Ethereum and Solana for confirmation. Watch XRP around resistance. And most importantly, watch your own emotions, because those are usually the first thing to break. One more thing, and this is important. Do not confuse volume headlines with risk management. When you hear that money is coming into Bitcoin products, that is useful information, but it is not a stop loss. It does not tell you where you are wrong. It does not tell you whether the next candle is going to punish late entries. Flows are background pressure. Levels are decision points. That is why I would not build the whole plan around one headline. I would build it around behavior. Does Bitcoin absorb sellers near resistance? Does it close strong after testing the level? Does it pull back and find buyers quickly? Or does it push up, stall, and then start making lower highs, while everyone keeps repeating the same bullish talking points? That little difference is where accounts are protected. And remember, the macro backdrop is messy. Oil has been moving on geopolitical tension. Rate cut expectations keep shifting. Tech earnings are carrying a lot of weight. Consumer confidence has been shaky. So if markets suddenly decide to reduce risk, crypto will not be immune just because the long-term story sounds beautiful. Beautiful stories can still have ugly pullbacks. I also want you to notice liquidity. When Bitcoin sits near a big round number, everyone can see it. Breakout buyers see it. Short sellers see it. Algorithms see it. That makes the area crowded. Crowded areas often create dramatic candles, not clean answers. So do not let one dramatic candle make the entire decision for you. Let the market show acceptance. Let the retest speak. Let the close matter. That is boring, but boring often keeps people alive. And the goal is not to be early on every move. The goal is to be right enough, patient enough, and protected enough that one bad candle does not erase months of good decisions. That is how real traders survive the exciting parts and the boring parts, because survival, not excitement, is what keeps you ready for the next real big opportunity. The first move gets attention. The second move tells the truth. None of this is financial advice. I am not telling you to buy, sell, hold short, or chase anything. This is educational market commentary meant to help you think through risk, levels, and scenarios like a calm adult, not a candle-chasing maniac with a phone in one hand and panic in the other.